Welcome to the daily update, where I'll go over the action in the market for Friday, October 25th. Then we'll see how things look for Monday, October 28th. Before I get started, where I'm residing right now, they sometimes play with the internet connectivity. There's some news going on, and sometimes they either throttle back or cut off internet activity. This is the weekend. It's when I plan on doing all of the weekly videos. But if I'm not connected, there's no way I can upload those. So let's just hope that everything works out okay. It was off yesterday, my time, but by the time I got ready to do this video, everything was back up again. But that could change at any time, just like things in the market. So we ended up closing slightly down on Friday. Now, on one hand, you can take that as negative because we gapped higher. We were really going up, looking strong. Then interest rates started to change. We hit the 200-day moving average on the 10-year yield. That's what I found as a point of support. And that's why we do intermarket analysis and not just one or two charts. We look across the market. The 10-year yield came down to its 200-day moving average and then started bouncing up. That's about the time stocks started to reverse. And we ended up giving back all the gains and closing slightly lower on the day. That's the negative side. Now, on the positive side, growth had a pretty good day. The mega caps and the semiconductors, they were pretty strong. It was the broader market and the value areas that kind of took it on the chin. We'll have to see if something like that can continue because usually it's when growth outperforms value. That's when we do better. And I'll show you some of those charts as we go through the video. There's a thing called the SPXInvesting Program. It's up, it's going, it's free until the end of 2024. Please feel free to check that out. If you have any questions, send me an email. If you want to set up a time to talk about it, we can certainly do that. There's a link that'll take you to the website as well as to a video below this video. And one of the benefits is you get the videos as I prepare them right when they're available instead of getting them later on YouTube or Rumble. Also, the daily video is the real hub of what I do as far as analysis. I mentioned the weekly videos. Those are the videos around the outside. I won't be doing a supplemental video, but all the other videos I will be preparing. And those are all meant to tie into the daily video. Okay, right at the open. Futures were looking strong. Europe was looking pretty good. Kind of what we saw in Thursday's session. And then we saw some selling into strength and everything chopped sideways on Thursday. Well, it looked like on Friday we were going to really move to the upside, and we did at the opening. That's why I always say it's the amateurs who open the market, it's the professionals who close it. I'm not a big buy the dip fan. You had people that were trying to do that, especially in Thursday's session, and it looked like a little bit in Wednesday's session as well. I want to use as many of the closing values as I can to determine where we're at. And you can't do that until the market closes, but we still keep an eye on what happens within the day itself. So we opened above R1 at 58.23. We got above R2 at 58.37. Then we hit resistance, and that was about the time we hit the 200-day moving average. With the 10-year yield, we came down, we bounced up off of that. Now interest rates started to go back up. That drove stocks back down to R2. Then we fell below R2, R1. We fell below the unchanged level. We found support at the daily pivot at 58.04. So now we're back down to dealing with that 5,800 level. We had been up into the high 5,800 range. Now we're down in the lower 5,800 range. And then prices were able to rise back up to R1, but then declined going into the close, and we ended up down slightly on the day. We were down 0.03% on below average volume. We are still positive, though, in the short, intermediate, and long term, but we're getting a lot of mixed signals with our indicators. And I measure if we're positive by the 20, 50, and 200-day moving averages, and we're still above those. That level is holding, but we're seeing some internal measures that we look at showing continued weakness. Really not much of a change with inflation. Of course, interest rates, they were going higher. They started to come back down. That gave support to stocks. Then when they started to go back up, suddenly now the market is paying attention to that. And then all the geopolitical things going on. There's stuff happening in Israel, and there's threats going back and forth between Iran and Israel. But again, will that have an impact on the market? It's not really having much of an impact on oil. And then the US election. We're coming down to a week and a half or so until that's going to happen. And who knows what kind of upheaval that can bring. Not so much to affect the stock market, but are some antecedent type events going to happen that will ultimately come over and have an impact on the stock market. Okay, some comments. The NASDAQ 100, and the growth ended up being positive on the day. It's really value that took kind of a hit. And that could end up being positive in the bigger picture, where the NASDAQ set an intraday all-time high. Not a closing high, but we did get to an all-time high with the NASDAQ. So we have the Dow and S&P recently setting all-time highs. Now that's been confirmed by the NASDAQ itself, at least on an intraday basis. The broader market was weak compared to the S&P 500. Mega caps and semiconductors outperformed. And then we did see an intraday reversal at least based on what I was watching, we found support at the 200-day moving average of the 10-year yield and then bounced up off of that. The VIX is now back above 20. We're not getting any of our VIX signals right now, so I'm not showing those charts. But when the VIX gets above 20, that's when we see negative annualized returns. And we want to keep an eye on what's happening in the Middle East. Oil is around the 71 to 72 level. And on a short-term basis, we have the stochastics. That's been on the list and really didn't go away. But the Sean trend meter picked up a little bit of strength, and it's not extreme, just kind of extreme. And I'll show you that chart too. We have some oversold indications already. We have the Stoch RSI, which has already been on the list for a couple of days. We're getting extreme with the McClellan oscillator for the S&P. We're dropping below that level. And then some of the PMO studies, I'll go through. There's one area on that chart that is looking extreme negative already, where we had another area that was extreme positive for a long time. And we're still looking extreme with the bullish percent index for the S&P, but it's declining. And that's causing a bit of a concern there. The 10-day new highs, new lows for the S&P 500, that's still looking strong. That's more intermediate to even a little bit long term. And that chart's still holding up for the time being. We're still looking good in the long term. We're above the lines that I have on the chart for the 150 and 200-day moving average, but they're coming down a little bit, but they're still above those levels, so they're extreme positive. No change to the scenario for right now. We're going to get a slug of economic reports in the upcoming week. Plus, we're getting closer to the election, plus all this stuff in the Middle East. So we'll have to see how things play out there. So I didn't change the scenario for this time. The dollar was up and interest rates were up. We're at 4.23% with the 10-year yield, where after Thursday, we were at 4.2%, and that did pressure stocks. But while we were going up along the way, stocks are like, we don't really care. Now they suddenly seem to care. We're still inverted with the 10 to the 3-month. The 10 to the 2 remains uninverted or back to being regular again. We're dropping down with sentiment. Now we're still positive, but we were a week ago at the 75 level. Now we've worked our way down to 59. So the context of that is it is declining, but we get a score of 59, so it's still positive. We are still positive with our trend. The ADX actually showed a little bit of an improvement there, and I'll have the chart to show you, but we're still below the moving average. So that suggests a weakening trend, but the green line is still on top. So we are positive, but in a weakening trending environment. And this, I rarely do this. The bias is usually positive or negative. Well, I put it mixed to negative. Negative because we gave back a lot of the gains on an intraday reversal, but mixed because growth in the mega caps and the semiconductors did pretty good. So that's why I came up with this particular figure here. And we're also mixed to negative with the momentum over the last 2, 3, 4, 5 days taken together, because we're seeing some positive things, but we're also seeing some negative things at the same time. Economic reports. We did get durable goods that came in down 0.8%. They expected them to be down 0.9%. Last time they were down 0.8%. If you take out transportation, they were up 0.4%, where they expected them to be down 0.1%. Last time they were up 0.6%. Consumer sentiment, the final reading came in at 70.5. The last time we had this, it came in at 68.9. So actually we saw a bit of an improvement there. So some charts. Here are durable goods on a year-over-year basis where we are showing a decline overall here. And non-defense capital goods, if you take out aircraft year over year, we're actually going up there. So it's aircraft that's kind of making the difference right now. Then on a month-over-month basis, we are negative a little bit less than what we saw in the previous month, but still down that way. Consumer sentiment, where if you look at the blue line, we're pretty much flat right now as far as sentiment is concerned based on the previous reading, up just a little bit, possibly. How people are feeling right now, they're actually turning a little bit more positive. That's the purple line. We're going out into the future, and there's a lot of uncertainty out there. Folks actually declined just a little bit. And then here's our chart of this coming in at 68.9. And then just to give it a little bit of context, I put the 2-year yield on here. Just they tend to go more in the same direction, but this has been coming down as sentiment had been coming down. Now we're seeing a little bit of a pop with both of these charts right now. All right, so looking at forward earnings estimates, and I'm also going to show this chart in the intermarket analysis video over the weekend if I'm able to do that. But this just plots in red the forward-looking earnings per share and what the S&P does. And you can see the really strong correlation between the two right here. So that's why we pay attention to the forward earnings. We look at historical earnings or the trending 12 months, but that's not what the market uses. They look forward when it comes to earnings, and as long as they're going up, the market tends to go up. Seeing a little bit of a dip down here, but we're looking at the bigger trend of what's happening. And then election years have never been lower after a red midterm year. Back in 2022, we had an election, and that just it was also a very difficult year for the stock market. And so what happens when we have a regular election year, 2024, and here's all the stuff that you can go back and look at. Who was running? If they're blue, they're Democrat. If they're red, they're Republican. And then what's the average for the year? 24.6%. And then during an election year, it's 13, or pre-election year, and then 13.2%. We don't know what that's going to be because we're not quite sure how things are going to play out here. And then the median is 26.3%. During the election year, it's 14.4% and up 100% of the time. So that's, you've got a lot of perma bears out there, and they're just sure everything is going to fall apart. And who knows? We may have some black swan event. Something crazy could come in. The election could get tampered with somehow. These are the concerns that are out there. But to this point, we haven't seen anything at least too crazy. And then this chart also breaks it down depending on whether it's a Democrat or a Republican. But I often say it doesn't matter to the market. You can see where we're up no matter who is in office. What they really want is a split in Congress between Republican and Democrat. That's what the stock market would like. And then the earnings per share with the long-term trend and the corporate tax rate. Earnings growth has been relentlessly steady over 90 years, regardless of who the president is or what the tax policy is. So this is just showing the long-term earnings per share and the trend, the earnings per share, which constantly go up. And then here are the corporate taxes. They're actually going down. And there's some proposals that if things do change after the election, that corporate taxes may even come down more. Okay, and then never say never. That's one thing I've learned. This chart is just saying that we're never going to go back to the low interest rate levels that we had after the great financial crisis. Okay, never say never. Okay, now where we're at now is more historically where we've been. But if something crazy really happens and the economy is really suffering, yeah, the Fed's going to come in and cut rates, and we could go back down to that level. So this is almost like a dare here with this chart. Then the Goldman Sachs chart here, I guess, yeah, the top-down estimate versus a consensus of bottom-up estimates for the earnings per share. With the S&P 500, the takeaway is we're looking at pretty solid strength here. I thought Goldman Sachs was GS. Yeah, it is Goldman Sachs. Their global division here. That's a big takeaway with earnings. And then the average annual US budget deficit is a percent of GDP. I showed some charts like this a while ago, but this breaks it down according to president. Here, see in Washington, Jefferson, all the way up here, where a lot of this is the embracing of modern monetary theory, if you know what that is. And that's really what's happening here. That's what's been happening over the last 3, 4 years anyway. And that's why we're seeing an awful lot of deficits. This is pretty much by design. And, Congress has never met a dollar that it couldn't spend 3 times. And large earnings days moves are occurring more frequently than any time in 15 years. The percent of stocks that move more than 10% on their earnings day, it's up to 12% now. So we're seeing pretty big swings. Now that could be upside or downside. They're just measuring the percentage of the move. And then here we have the average 1-month S&P 500 return against the change in the 10-year Treasury yield. So you can just compare the real yield. This takes inflation into account, and then the nominal yield here. And interest rates do have an impact on how stocks actually perform. And cyclicals versus defensive, this is what we keep an eye on. This is kind of a variation of growth versus value, discretionary versus staples. Cyclicals tend to go up when the economy is doing better. They go down when the economy is weaker. But cyclicals, according to this chart, are still doing quite well. I spent time on Twitter, but didn't really see anything there that was worth sharing with you. But this was kind of disappointing for those that tend to get in right after the open, where we did gap higher above R1 and we made it all the way up here, kind of hit another previous level that was set back on Tuesday. And then everything started to fall back and then turn into an actual reversal. We came back down to R2, tried to find some support there, tried to bounce up off of that as some buy the dip folks were coming into the market, but that wasn't working. We ended up breaking down below S or R2. We just sliced through pretty quickly. S1 came all the way down to the unchanged level, found some support at the daily pivot, tried to bounce back up to S1, R1 from there, but then drifted lower going into the close, and we were down slightly negative. So on the surface, yeah, it looks like, oh my gosh, it's a stock that you got into, you got in at the high and then ended up getting near the low by the time we closed. That's pretty disappointing here. But the futures were actually looking pretty strong before we opened, and that gave us the gap higher open, and things looked like they were off to the races, but then everything reversed, and then we actually closed down a little bit lower than that as things closed for the weekend. But this is one of the positive takeaways. We have the blue line above the red line when we look at intraday growth versus value with the large cap growth here, where it was off of its highs, but you can see the red line going down as the blue line more or less has been going up. And then this is also encouraging if you want the S&P to go up or you're more positive on things. We were still going up. We didn't give back much of the gains even after we saw the reversal here on the intraday chart when we look at growth versus value here. End of day, growth was up where value ended up being down, and by a lot, especially with the large caps. Value just got shot. And growth was down less for the mid caps and also down less for the small caps. So a little bit of an improvement here with small cap growth to value, but we're still in a downtrend with this overall ratio. Little bit of an improvement here with the mid caps, but still in a downtrend. Seeing a little bit more strength here with S&P growth to value. So this is actually showing a bit of an improvement, and this ratio is in an uptrend. And we're seeing an improvement where we were able to come out of the top of the rainbow when we look at the growth versus value ETF. So that showed an improvement there. And discretionary to staples, showing some improvement here. These are the areas that we want to do well if we want to buy low and sell high. But we need to see follow through with this. They're showing some improvement and they held up pretty well on Friday. Are they going to be able to hold up more in the near future? Large cap growth still looking good, up 0.5%. Condition of the trend, we actually are turning back up just a little bit with the ADX, but we're still below the moving average. But you can see the green line actually went up. It picked that early strength up in how it's calculated. So we see the green line going up and the red line going down. So we don't like that it's a weakening trend, but we like that the green line's going up So we're still positive with this chart. Also seeing a bit of a change here with the green line going up when we look at the short-term ADX. So this chart is still positive too, but we're still below average with volume. That seems to be the name of the game right now. But we're back above 20 again with the VIX. Market didn't like that reversal that it saw. And so there's a lot of hedging going on ahead of the weekend. So we're into that area where we tend to see negative annualized returns, both with the line chart and the bar chart. And when the VIX goes up, the VIX of the VIX also goes up. We're getting back well above these moving averages. We're still going down as far as the VIX, but the MACD is starting to turn up a little bit, but it has not crossed above its moving average, at least yet. And we're coming into that time now. We're playing out this period where the VIX tends to be higher, which typically means stocks go down. But we've been dealing with a higher VIX and stocks have been holding up fairly well. That's why those other VIX signals have been triggering. We ticked up just a little bit with this fear gauge and we ticked up with this other fear gauge. So we're seeing a little bit of confirmation there. Still getting a high reading with the volatility risk premium. So that's just suggesting they're anticipating risk going out 30 days. But we declined with the equity put call ratio on the daily chart. But now we started to come back up after being extreme negative here with the equity put call ratio. But this is chopping around. We're not really seeing any sustained movement one way or the other. I mean, we could have an up day on Monday and this could start to go back down. So we just want to bear in mind that this going up is usually negative for stocks, especially after we get to a negative reading here below this red line. But we've seen that a couple of times before and it didn't really lead to anything. We're getting an extreme reading here, and this is a longer term chart just to give it some more context. We're also going back up with the 10-day average of the put call ratio here. The advanced decline line did come down based on price, but we actually went up based on volume. So volume held up better than price. It could be a lot of money going into the mega caps. They have more of an impact on the S&P. And not any real, well, we saw a drop off here with the new highs, but not any real deterioration and really no expansion of the new lows. Still going sideways near the top end of the range here with the 5-day, and we're starting to go back down with the 10-day. We're dropping negative with the blue line. That's the short-term advanced decline ratio based on 19 periods. We're coming down, but still positive with the 39-day advanced decline ratio. And we actually showed we're holding up. A little bit of an improvement here with the boom indicator. Actually, it came down just a little bit, but we're still above an advancing moving average when we look at accumulation distribution. So it's coming down, but still looking positive. And we were getting some encouragement from the Chaikin money flow. Well, not so much after Friday. We saw the histogram come down. The red line had started to go back up. Now it's starting to go back down. So we're seeing a little bit of weakness here. And the Chaikin oscillator, which had been going up, is now starting to go down. Now, all three of these indicators, the accumulation distribution, this is a smart money indicator, the Chaikin money flow, and the Chaikin oscillator. We're still positive. We're just looking at the context of are they going higher or lower. The vortex showed some improvement with the green line going up and the red line going down. That's more positive. And we came down a little bit here with the S&P 500 advanced decline cumulative measure here. And we declined with this based on volume, but nothing, actually we went up just a little bit based on volume. And so we're seeing a little bit of a disconnect here between the NYSE advanced decline line and the S&P. They're on different scales, so they're going to get out of whack with each other here. But the red line's going down as the S&P actually is holding up a little bit better. And we came down to the moving average with the cumulative advanced decline line for the NYSE. Saw a little bit more of a decline here with our regular NYSE advanced decline line. When we break this out based on common stock, we were actually down just a little bit here and down a little bit based on volume as well. And when we look at the advanced decline lines, we're still above the moving averages with the NYSE common stock, even though we're coming close to the moving average. We declined slightly with the S&P 500, the mid caps, and we're actually starting to drop below the moving average with the small caps. And those stocks above their 20-period moving averages were below 50 and declining. So this has actually turned negative now. We're declining, but still positive with those stocks above their 50-day moving average, declining but positive above their 100-day moving average, and still positive with those stocks above their 200-day moving average, even though this is declining. So I was trying to see if we hit this pivot level here, but we never got quite up to that point. That was not the overhead resistance that we hit. On the bottom, we are below average with volume, and we're declining with the 20, 50, and 200-day moving averages on the S&P. The Stochk RSI is still extreme negative, but it can stay that way for a while. We're declining, but still above the midpoint with the Williams percent R, just a little bit above the midpoint with the CCI 14, and going back up slightly and above the midpoint with the CCI 20. So even in the short term, we're not seeing across the board confirmation. We're declining, but still above zero with the short-term stochastic, declining also above the midpoint with the intermediate-term stochastic, declining but extreme positive with the long-term stochastic here. We came up just a little bit, but we're still negative with the force index. The condition of the 20-period moving average study here, we're dropping further below the blue line and the green line, and the lines are just starting to roll over. We were hoping for an up day and to see these lines start to go back up if you're more positive. We just want to keep an eye on this. This shows us, helps to see the condition of the short-term trend, but we're still well above the simple and exponential moving averages based on 20. We didn't even get down that far in Friday's session. We're still slightly above the midpoint with our standard deviations chart. Intermediate term, balance of power actually went up and we're positive there. We're dropping below the blue line here, and we've already been below the red line, so we're keeping an eye on the condition of the 50-period moving average. The no-go is looking a little bit more negative with the lighter blue bars. We're still barely above the midpoint with the highest high value. TTM squeeze never did really go positive. It just keeps drifting lower and lower and lower each day. We turned up a little bit, and we're still positive with the ease of movement. And we're flat after declining with the Erin indicator, but this is still positive since we're above zero. We're starting to get extreme negative with the McClellan oscillator for the S&P. We're dropping below this blue line here. So we're going down with the summation index based on price and volume. And this is a primary indicator that continues to be negative, where we have other indicators that are still looking positive. And we're declining, but not extreme with the NYSE McClellan oscillator. So we're going down with the summation index based on price and volume. Swenlin trading oscillator, kind of in between a primary and secondary indicator, in my opinion. We're below zero and declining based on price. We're also below zero and declining based on volume. We're seeing a little bit more intensity as we're going down based on price. Momentum is starting to turn more negative. We're crossing below the moving average with the PMO. When we break it out based on price and volume, we're also declining below their moving averages. And we're just barely getting extreme with the PMOs that are rising. This had actually been holding up quite well. Now we're seeing PMOs start to decline. And we're going down with the buy signals. And we're also seeing a decline here after being extreme positive for quite a while, pretty much all of October and even back into September, with the PMOs in the S&P that are above zero. We continue to be negative with the Elder's Impulse system for the S&P, but we continue to be positive with the parabolic SAR. So that's why we're getting mixed signals here. We're coming down just a little bit, but right on top of the moving average with the slope oscillator. We're negative with the MACD. And so we're pretty much flat with the slope, turning down a little bit with the TSI. Those are the short-term oscillators. Then I have three intermediate-term oscillators, the MACD, PMO, and PPO. Those are negative. Starting to look a little bit more negative with a long-term oscillator, the TRIX, still right on top of the moving average with the KST. And the copy curve, after trying to get above the moving average, now it's starting to drop below the moving average and turning back to negative. The Sean trend meter actually went up. We're in this kind of Pepto-Bismol green area. I know Pepto-Bismol is pink, but when we really get nervous about this is when we get up into this darker green area. But to see this turn up after what we saw is kind of positive right now. And we're above 50 and going up with the money flow, but we're declining still barely above 50 with the ultimate oscillator. We're still above the moving average with on-balance volume, even though it was down. We're still above the midpoint here with the RSI 14, and we bounced up slightly off of the midpoint of 50 with the short-term RSI. We're still above the moving averages here, so that is more positive. And even though the bullish percent index is positive, the context is that it's coming down, and it really declined. And it was coming down even while we were going up. And I noticed that while the session was open on Friday. We're also coming down after getting a very high reading with the NYSE bullish percent index, and we declined with the NASDAQ 100 bullish percent index, but we're still positive since we're above 50. And we're playing around with some of these levels here when we look at the simple moving average of the open, high, low, close based on 20 periods. Sometimes when we're above and we pull back, one of these lines may act as support, and so far that's been playing out. And we're looking a little more negative here. We have kind of a doji looking candle with the Heiken Ashi chart, where we're negative but pointing up with the Kegi chart. We're still positive with the Renko chart, and we're still positive with the 3-line break chart. Long term, coming down, but still above this red line with the 150 and 200-day moving averages. We're negative with the mid caps and small caps in the short term. All the other indexes are positive on all the different time frames. We're still negative based on price in the short and intermediate term with bonds, where we're negative with commodities and the dollar long term. And we only had 3 areas that ended up being up: tech, discretionary, communication. Those are the areas that we want to have up. Now, they gave back their gain, a lot of their gains, but at least they were positive, where all the other sectors ended up really being down on the day, with utilities leading things lower. So we saw some kind of initial things. This is more of a defensive area. The bullish percent index below 50 for healthcare. Yeah, that is more defensive. And then staples, another defensive area, also had a BPI cross below 50. That could actually be positive for growth, because we've been keeping an eye on staples and healthcare, where the NASDAQ got above 18.5. It was up on the day, and the NASDAQ got above 18.6, and it set a new all-time high. And then we had discretionary setting a new all-time high. These are potentially positive things that are developing under the surface of the market. And not really seeing much of a change here, but we saw more of a decline when we look at the S&P versus the equal weight version of the S&P. That just means the mega caps were stronger. The Dow ended up being down, but still above its 50-day moving average, and we're still negative with the Elder's Impulse system for the diamonds. The NASDAQ set that. Is that really an intraday high? No, I'm not so sure about that now. I may be incorrect. I was going off of some different information and looking at a different chart here. We may not have set an all-time high with the NASDAQ. We're not really close to an all-time high with the NASDAQ 100 either. And we're positive, though, with the Elder's Impulse system for the Qs. The momentum, though, for the NASDAQ 100 continues to be negative. We're below the moving average, but we're still above the 20-period moving average with the QQQs. Small caps, of course, they had to be down. After having that really nice run up, they had to give most of that back, and we're starting to fall below the 50-day moving average. We're negative with the Elder's Impulse system for the small caps, and still above the 50-day moving average when we look at the Russell 2000 small caps, but below 50 with the RSI, and the momentum is negative as well. Mid caps also ended up being down, but still above their 50-day moving average, but they continue to be negative with the Elder's Impulse system. The Wilshire was down not very much, so the broader market, according to this, held up a little bit better. And we were down 0.09% with the US stock ETF. So this is coming off of recent all-time highs and still holding up fairly well. Just kind of chopping around right now when we look at the staples to tech ratio. We want this to go down to be more positive. If it goes up, that's more negative. Financial sector seeing some profit taking after setting a recent all-time high. FANG index was actually up 0.42%, but closed well off of its high. Amazon was up 0.78% here, above its 50-day moving average. Apple was up a little over 0.33%, also holding up above its 50-day moving average. Microsoft still bouncing up off of its 200-day moving average. Google was up over 1.5%, but just kind of chopping sideways for the most part. Meta was up 0.96% above its 50-day moving average. NVIDIA was up 0.8% and still looking good. This is why the indexes didn't fall apart and why growth did so well. And Tesla was up 3.33%. So you take all these together and they were up, where a lot of the other areas of the market saw some weakness. Netflix was virtually unchanged, but coming off of a week ago, they had reported earnings and just skyrocketed higher. And we're seeing a little bit of an improvement here on the short-term correlation chart between US stocks and world stocks, but in the longer term, they're having a tendency for that correlation to go away. Oil still hanging out between 71 and 72. The dollar continues to be above its 200-day moving average, even though we're still in a downtrend as measured by the moving averages. And we ended up going back up. See how we came down to the 200-day moving average and then bounced up off of that with the 10-year yield. And we were down with the 10-year based on price. And saw an improvement here with Qs to S&P going above the moving average. Can we continue to go up, and can the moving average go up? We saw a nice little bounce here with discretionary to S&P. Can that continue? That would be more positive. And we saw an improvement here when we compare large cap growth to large cap value, but we need to see more follow through with this. So the large caps, mid caps, and small caps actually showed some improvement with their growth to value ratios. The S&P to utilities ratio not really helping the S&P out right now. For the most part, it's continuing to go down, even though it was up in Friday's session. But the bigger context is that it's been going down. And we want this to go down to be more positive on the S&P, the staples to staples to S&P ratio. And that's pretty much what it's been doing lately. So what's our outlook for Monday? We are still positive. And at this point, it looks like we're pulling back after setting those all-time highs. We do have this confirmed Hindenburg omen, but there's been no change in that chart, so I didn't show it. And we are seeing weakness developing as I went through in some of these charts. We're not going to have any economic reports on Monday. And then we want to keep an eye on the different geopolitical events, just in case they have an impact. Here is a pretty big calendar. Now, we're not going to have anything on Monday. We're going to get some real estate and jobs information on Tuesday, and then we're going to get GDP on Wednesday. That could be big. And then Thursday is going to be big, and Friday is going to be big as well. With the jobless claims and personal income and spending, we're going to get core PCE and the employment cost index. Those are coming out on Thursday. And then we're going to get the big employment report on Friday. We're going to get the final reading of the global manufacturing PMI. And then the other big report is going to be the ISM manufacturing index. So later in the week, we're going to get a lot of stuff for the market to react to. And here's a look at the upcoming calendar for the week with nothing happening for Monday. Seasonally, we're positive with the Dow, where we're neutral to positive with the S&P and NASDAQ. And this should be changed back to white because we're no longer in the week after options expiration. And after seeing some historical seasonal weakness here, we have come down. We now finish with Friday, where we see a little bit of a bump up, some weakness, and then typically some historical seasonal strength going into the end of October. And Monday is very positive when you compare it to 2023. It's not as positive, but still positive so far in 2024. And we're seeing a real drop off here in the companies that are coming out of their blackout period as they're reporting earnings. So they can't go in and buy their own stock. So we still have this confirmed Hindenburg omen. We're watching the defensive sectors. Now, they didn't do so well in Friday's session. Can that continue? That would be more positive for the S&P. And both the 5 and 10-day equity put call ratios are now going back up. But again, something could happen and we could shift around pretty easy. This hasn't been a real reliable indicator lately. We are getting extreme and dropping, not extreme, but dropping negative with the 20-period moving average study of those stocks inside of the S&P. The Swenlin trading oscillators negative. Both the S&P and NYSE McClellan oscillators and summation indexes are negative, with the S&P starting to get extreme negative. The oscillators are now turning back more negative. We're keeping an eye on growth to value. Did okay on Friday, but can we see more of that in the upcoming week? Discretionary to staples, also looking pretty good, but we're keeping an eye on that. That's why I keep this on the warning side of things. And the momentum for the NASDAQ 100, even though it was up, still continues to be down for the momentum there. We are looking okay, positive, but showing some weakness with our smart money indicators, accumulation distribution, the Chaikin money flow, and Chaikin oscillator. And that is no longer appropriate there. I should have taken that off. The advanced decline lines, we're dropping below the moving average with the small caps, but we're still above the moving averages with the other indexes that we follow. The S&P bullish percent index is declining after giving an extreme reading, and that's a concern to us. where the NASDAQ 100 and NYSEs, they're also coming down as well. We would like those to be going up. The parabolic SAR is still positive, though. The vortex is positive. Money flow, the ease of movement, and the ultimate oscillator is still positive. And the financial sector is positive also. So our conclusion, really no change here because we ended up being down just slightly. And the weakness that we've been seeing is just pretty much continuing, except for an improvement with the growth of value and discretionary to staples. We're still positive right now because we're above the 20-period moving average, but weakness is developing. And we're holding up above the 20-period moving averages in the short term. We are seeing some weakness in the intermediate term. We'll see, can it switch back and turn more positive, or is it going to turn more negative? But we are still positive and looking positive with the long term. Thank you. I hope you have a wonderful weekend, and I will talk to you in the next video.